The debt versus spending dilemma. Are you a saver or a spender? This is a question that many of us grapple with on a daily basis. Our financial habits can significantly impact our quality of life, both now and in the future. In today's world, it seems like everyone is either in debt or struggling to save. The pressure to keep up with the latest trends and maintain a certain lifestyle can be overwhelming. Many people find themselves living paycheck to paycheck with little to no savings to fall back on in case of an emergency. We are bombarded with messages encouraging us to spend. Advertisements, social media, and even peer pressure can make it difficult to resist the urge to splurge. The allure of instant gratification often overshadows the importance of long-term financial stability. But what about saving for the future? It's crucial to set aside money for unexpected expenses, retirement, and other long-term goals. Building a financial cushion can provide peace of mind and security, allowing you to navigate life's uncertainties with greater ease. Is it even possible to get ahead when the odds seem stacked against us? The rising cost of living, stagnant wages, and mounting debt can make it feel like an uphill battle. However, with careful planning and discipline, it is possible to achieve financial stability and even prosperity. The truth is, we are facing a global debt crisis. Countries around the world are grappling with unprecedented levels of debt, which can have far-reaching consequences for the global economy. This situation underscores the importance of responsible financial management at both the individual and governmental levels. Governments are borrowing more than ever before, and individuals are racking up credit card debt at alarming rates. This trend is unsustainable and can lead to financial instability and economic downturns. It's essential to address these issues proactively to avoid long-term repercussions. But at the same time, interest rates are at historic lows, making it hard for savers to earn a decent return on their money. This can be discouraging for those who are trying to build their savings. So what's the answer? How can we strike a balance between spending and saving in such a challenging financial landscape? Should we be spending freely and enjoying life today, or should we be tightening our belts and saving for a rainy day? It's a delicate balance that requires thoughtful consideration and planning. While it's important to enjoy the present, it's equally crucial to prepare for the future. The answer, as with most things in life, is all about balance. Striking the right balance between spending and saving can help you achieve financial well-being and peace of mind. It's about making informed decisions and prioritizing your financial goals. It's important to enjoy the fruits of your labor, but it's equally important to plan for the future. By finding a balance between the two, you can create a fulfilling and secure financial future for yourself and your loved ones. Remember, it's not about choosing one over the other, but rather integrating both into your financial strategy. Understanding debt and saving, a tale of three players. To understand this dilemma, we need to look at how debt and saving work for different players in the economy, governments, businesses, and individuals. Governments borrow money to fund public services like healthcare and education, or to invest in infrastructure projects. Businesses borrow to expand their operations, hire more employees, and develop new products and services. Individuals borrow for big purchases like homes or cars, or to cover unexpected expenses. We save for retirement, for our children's education, or simply for a rainy day. Each of these players has a role to play in a healthy economy. But when debt levels get too high, it can create problems for everyone. The silent thief: how inflation eats away at your savings. One of the biggest challenges facing savers today is inflation. Inflation is the rate at which prices for goods and services increase over time. When inflation is high, the purchasing power of your money decreases. Let's say you have €1,000 in savings. If inflation is at 2%, that €1,000 will only be worth €980 in a year's time. This might not seem like a big deal, but over time, inflation can significantly erode the value of your savings. In many European countries, inflation has been stubbornly high in recent years. This means that even if you are diligently saving your money, it may not be growing as fast as the cost of living. The low interest rate trap: why saving doesn't seem to pay off. In today's financial landscape, many savers are finding themselves caught in a frustrating dilemma. To make matters worse for savers, interest rates on savings accounts are at historic lows. This means that the money you set aside in a savings account is growing at a snail's pace, if at all. In some cases, the interest you earn on your savings might not even be enough to keep pace with inflation. Inflation, the gradual increase in prices over time, erodes the purchasing power of your money. This can be incredibly discouraging for savers, who are essentially losing money by keeping it in the bank. Imagine working hard to save, only to find that your money buys less and less each year. It's no wonder that many people are choosing to spend their money today, rather than watch it slowly disappear to inflation. They prefer to enjoy their earnings now, rather than see their savings dwindle in value. This low interest rate environment is largely due to the policies of central banks, which have been trying to stimulate economic growth by making it cheaper for businesses and individuals to borrow money. These policies are designed to encourage spending and investment. While these policies may be well-intentioned, they have had the unintended consequence of punishing savers. Savers are left with few options, as traditional savings accounts no longer offer a safe haven for their money. As a result, many people are turning to alternative investment options such as stocks, bonds, or real estate in search of better returns. However, these options come with their own risks and challenges. It's important for savers to carefully consider their financial goals and risk tolerance before making any investment decisions. Diversifying your investments can help manage risk and potentially increase returns. Ultimately, the key is to find a balance between saving and spending that aligns with your personal financial situation and long-term goals. By staying informed and making thoughtful decisions, you can navigate the low interest rate environment and make the most of your money. You might be wondering why governments and central banks seem to favor borrowing over saving. There are a few reasons for this. First, when interest rates are low, it's cheaper for governments to borrow money. This can be tempting for governments looking to fund ambitious projects or to plug holes in their budgets. Second, central banks often believe that encouraging borrowing and spending can help to boost economic growth. When people and businesses have more money to spend, it can lead to higher demand for goods and services, which can lead to economic growth. However, this approach can also lead to higher levels of debt, which can create risks for the economy in the long run. High levels of government debt can lead to higher interest rates, which can stifle economic growth. Section 6. Navigating the financial maze, tips for beginner investors. Investing can seem daunting at first, but with the right guidance and mindset, you can make informed decisions that will benefit you in the long run. So, what can you do to protect your finances in this challenging environment? The financial world is full of opportunities and risks, and it's crucial to be prepared. Here are a few tips for beginner investors. First, start saving early. The power of compounding can significantly boost your savings over time. The earlier you start saving, the more time your money has to grow. Compounding interest means that your money earns interest on both the initial amount and the accumulated interest from previous periods. Even if you can only save a small amount each month, it will add up over time. Consistency is key, and small regular contributions can lead to substantial growth. Second, don't be afraid to invest. Investing can help you achieve higher returns compared to just saving. While saving is important, it's also important to invest your money in assets that have the potential to outpace inflation. This ensures that your purchasing power doesn't diminish over time. This could include stocks, bonds, or real estate. Diversifying your investments can help spread risk and increase potential returns. Third, do your research. Before you invest your money, it's important to do your research and understand the risks involved. Knowledge is power, and being informed can help you make better investment choices. Don't be afraid to ask for help from a financial advisor if you need it. Professional advice can provide valuable insights and help you navigate complex financial decisions. And finally, be patient. Investing is a long-term game. It's important to stay focused on your long-term goals and not get swayed by short-term market fluctuations. Don't expect to get rich quick. Quick profits often come with high risks, and it's better to aim for steady, sustainable growth. Be patient and stay the course, and you will be rewarded in the long run. Remember, the journey to financial success is a marathon, not a sprint. With careful planning and disciplined investing, you can achieve your financial goals. Section 7. don't be afraid of the stock market. A beginner's guide to investing. Many people are intimidated by the stock market, but it's not as complicated as you might think. Investing in the stock market is simply buying a small piece of ownership in a company. When you buy stock in a company, you are betting that the company will do well in the future and that the value of your stock will increase. If the company does well, you can sell your stock for a profit. Of course, there is always the risk that the company will not do well and that the value of your stock will decrease. That's why it's important to diversify your investments and not put all your eggs in one basket. Section 8. Diversification is key. Don't put all your eggs in one basket. Diversification is one of the most important concepts in investing. It simply means spreading your money across different types of investments. For example, you might invest in a mix of stocks, bonds, and real estate. This way, if one type of investment performs poorly, your entire portfolio won't be wiped out. There are many different ways to diversify your investments. You can invest in different sectors of the economy, different geographic regions, and different asset classes. Section 9, the future of finance, taking control of your financial destiny. The financial landscape is constantly changing, but one thing remains constant: the importance of taking control of your financial future. By understanding the forces at play in the economy, like debt, inflation, and interest rates, you can make informed decisions about your money. Don't be afraid to seek out information and ask questions. The more you know about personal finance, the better equipped you'll be to navigate the challenges and opportunities that lie ahead.